Okay. Welcome to the future. Oh no, I'll do better than that. Can't half-ass it. Welcome to the Futures Edge podcast. I'm Jim Urio. As always, brains behind the operation, co-host and executive producer Bob Icino. Oh yeah. Again, I will turn this bottle around when you guys sponsor us, but until that time comes, no.
You'll like this. I don't know if you can see this, but this is actually my map of Chicago bourbon glass.
Oh, I can kind of see it. That's pretty cool. And what kind of bourbon? Angel's Envy again?
It's actually Peerless.
Okay.
Yeah,
well, find a small company.
Peerless is a really good affordable bourbon that people haven't bastardized yet by making it $4,000. Good. It is actually, I don't know if this is longitude or latitude. I'll have to ask Mike because I'm positive that's something else he knows a lot about.
I'm sure.
You guys are making me thirsty.
Speaking of Mike, our guest today on every Friday, which is one of my favorite shows because I learn the most, is Mike Arnold, founding partner of Path Trading Partners and chief technical strategist. Thanks, Mike. How are you?
I am doing fine on this fine non-farm payroll day with a little bloodier than I expected. We had some potential short setups, but this, wow. Oh, wow.
Yeah.
Okay.
Wow is right. Again, we tape on Friday afternoons, and the market got the absolute shit beaten out of it today, and it continues right now. Bobby and we're going to talk a little bit about fundamentals first, which you, by the way, you are totally welcome to join in. But you always, because it's non-farm, we figure we spend 5 minutes on that before we get to the technicals. Is that cool with you?
Oh, that is perfectly fine with me.
Okay, Bobby, here's my theory today.
He hates fundamentals.
Here's my theory today, and I think you disagree with me. So I think the market would have been okay with a non-farm number that was much worse than expected because it would have given the opinion that the Fed may soon move to neutral. Or I think the market would have been kind of okay with a number that beat by a ton because the market would convince themselves that yes, the Fed's going to continue tightening, but maybe they probably should. The number that came out, which was kind of as expected, but a hair better, is this limbo number where the market, I think, is screaming that the Fed is tightening, but maybe they shouldn't be. What do you think?
I think the market is screaming the Fed is going to continue tightening. I don't think the market is giving any opinion on whether they should or shouldn't. And part of the reason I keep saying that, and I want to go on record as saying that, like, sometimes I feel bad because we're friends, we're partners on the show, co-hosts, we're partners in other things as well. And I feel bad because I feel like I'm coming after you, but you're the most vocal about the Fed going too far that I watch a lot on social media. And I keep trying to tell people that, and I'm not saying I'm right on this, I'm just saying that if you're looking at a recession or a collapse of equities as the litmus test for the Fed going too far, they don't give a shit. They're not looking at that. Okay. And I understand for like people that watch our show, maybe that's a litmus test, but that's not it. Like, from a perspective of what they're doing, they've told you, look, we've meddled in markets that we shouldn't have before. We've opined on markets that we shouldn't have before. We've adjusted our stance because of markets that we're not really charged with managing. And we're not doing it anymore. And they've been saying it for weeks. So, when we look at something from a perspective of like, well, they shouldn't keep doing this. Like, if you look at inflation, hell yeah, they should.
Okay. And I listen, and by the way, I have no problem with you coming after me. I love when we have intellectual disagreements, but I will ask you this. Can we find common ground here? Because we all know that tightenings and eases have an obvious lag time, could be as much as 6 months, 8 months, that it is a mathematical certainty that they will overdo it if they're looking for very, very visible signs that the economy is slowed. Do you understand what I mean by that?
Yes, I do. And I would say, based on what you and a lot of our audience would consider overdoing it, I have to agree. But what I'm saying is, they're saying, and they continually say it, Kashkari said it today, Waller said it again today, we need inflation to get near 2%. They're talking about core. So if you're saying they've already overdone it, then in my view, given what they're saying, you're saying that inflation is going to drop below 2% on the core. I don't think it is. Not based on
it's
what
not
they've done
gonna
so
until
far.
they get different base effect.
Right. So, well, I'm not
from
even
what's
talking
happening.
about, I'm talking about month over month core inflation, which, may get us to a base effect of somewhere around 3.5 or 4%. But that, again, people forget their target's 2, man. It's 2. And Powell said in 2019, it would be okay to overshoot since we undershot for so long, right? So now we're saying, is the Fed now going to be saying, since we overshot for so long, that it's okay to undershoot? I don't know. We're not there yet. So I think based on a target of 2% sustained core inflation, no, they haven't overshot yet.
Okay. I will say this, and I've said it a lot of times,
Yeah.
is that
I'm also drinking, so I could be not.
No, sure, no doubt. It's easy for the Fed to talk all ballsy when the stock market is not, but it has gone quite a bit lower, obviously. And you said they don't care if they drop the bottom of the stock market. And I think what you mean is within reason. You know what I mean? They're going to care if it's 45% off the highs, right?
No.
Oh, wow. Okay.
I don't think so. I don't think any level of stock market suffering matters to them unless it has an effect of bringing inflation down. I don't think they care.
Okay.
Can I ask a question?
Yeah.
Sure.
Jim, because I follow your Twitter feed and I see, your thoughts on pivot or pause, whatever the language we are using at the time. And yes, the data is lagging. I will completely agree with you. And I'm actually more in they got to keep going. Even though I'm no fan of the Fed, I think we should not have a Fed if you want to get ready to do it.
That would be much better. Yeah.
I don't think you can make intelligent decisions, even with some of the best models in a macro economy like this, and fine-tune stuff and try to micromanage everything down to 0.25% rates and get a soft landing, whatever kind of landing you want.
Yeah.
I don't agree on the upside. I don't agree on the downside. That given said, what would be your strategy? I am actually very fascinated with this. Since the data is, let's call it 6 months lagging, what is your strategy to know when you've overshot or how much inflation is going to come in if there's that lag that would prevent, if you were miraculously in charge of the Fed, what would prevent you from overdoing it?
Okay, if I was miraculously in charge of the Fed, we'd never be in this spot because I wouldn't have bought mortgage-backed bonds a year and a half ago into a teeth of a
I'm not saying you would have put us in this spot. I'm saying you just inherited it today.
That, by the way, is exactly where we agree. I tweeted this week before you answered, Jim, that the Fed is now, we're looking at water damage from what they're doing. I made the comparison and both of you retweeted this for different reasons, I think. Now, if you get mad at the Fed for causing a recession, it's like getting mad at a fireman for putting out a fire, and the water damage now has stopped this business from opening because they were putting out a fire. But they also helped cause the fire. I think that's what you're saying, Jim.
Yeah.
And that's the reason Mike retweeted it, is like they caused the fire. Now they're putting it out, and we're getting mad at the water damage rather than saying, a little fire is okay. None of us would actually say that. I'm sorry. Go ahead, Jim.
No. I like that metaphor actually quite a bit. What I would do, I guess, is I'd go through with the 75 basis point. Again, we're a week away from the CPI number that's going to provide. Again, I think it's somewhat of a bullshit number. The way it's calculated is bad, but we do know that the Fed is watching it, and we do know that it provides some actual usable information in it. So we have that on Thursday, correct? So we have that number coming out on Thursday. I would do this, plan every bit on doing the 75 and do it. But if that number came out, much lower than expected, the month over month, year over year, I'm not as interested in because of those basing effects. But if it came out as if inflation was going down precipitously, then I would talk a little easier, say, okay, we're still ready to fight inflation. We got to give it a little rope right now. And that's all they can do, I think.
And what would your little rope be? What amount of time frame is what I'm asking? Because it's not like the data lags by a month, okay? So if you give it a little rope and then you get feedback a month later, because especially stuff like housing and everything else, takes many months to work its way through. So how much rope do you give it?
Well, I don't, this is a great question. I don't like this line of questioning because, by the way, I argue all the time that they've gotten themselves into an impossible situation and they're damned if they do and damned if they don't. So I underscore that. But then the rope I would give it is saying I'm planning a quarter point hike at the next meeting unless I get more spooked about inflation or unless I get far, far less spooked about inflation. That's the rope I give it. But, remember, not too long ago, 75 basis point moves were unheard of. They monkeyed it by a quarter point. And I think we could, if I was there, God, you got me all stuttery and everything. I don't ever want him on the show again. Right, so let's go to technicals.
Well, let me just throw two more things in. You're right about, obviously you're right about the 75 basis points. When you talk about I'm eating a protein bar, I haven't eaten all day. If you talk about 45% lower in the S&P, we're January of 2019 in the S&P, which I don't think is that horrible. It's not like we go back to 1948 or something. We're just January of 2019. That would be down 45%. And then we could build from there. That's why I don't think it's scary. 75 basis point rate hikes are unheard of in recent memory, but so is 9.3% headline inflation and 6% core.
No doubt about it.
In recent memory. The last thing I'll throw up is something from Cameron Dawson, who's a good fan of the show, who said to me, and I think we talked about this, Jim. I know I talked to Mike about it. What she says is wages is a big problem, more so than anything that's happening with the equity market, because implicit in wages is future inflation in wage increases. So, for example, and I'll use my brother as an example, but you're also a restaurant owner, Jim. My brother said, people keep coming to him and saying they need more money. Now, he's already raised prices based on his cost of goods going up. Then he raised prices again based on wages going up. And now some people quit because they get a job that's higher paying, Amazon, for example. And so the good ones he tries to keep by giving them another wage increase. And then as he's hiring people, he has to bring them in at higher wages. And Cameron says that implicit in wage increases, I don't want to misquote her here, is future inflation. In other words, you don't give those wage increases and you don't hire people at a higher wage unless you think that down the road you can raise prices to make it up. Otherwise, you just let them go or you close your business.
Right.
And so that's why I think wages and things like that are so sticky, is because there's inflation that hasn't hit us yet that's implicit in the wage increases we've seen. Anyway, that's not my work. That's Cameron. So
Cameron, and again, you guys who've watched the show before know Cameron, and we bow to her on many things. She knows everything. So
brilliant.
Let's go. Can we put up a chart of the S&Ps and take a look at what we got? Sift through the damage.
Hang on, Mike. I gotta make it so you can share. Hold on. All right. Do it.
So since this will be my last show for questioning.
No, you're too valuable. That was a moment of weakness by me.
Do you have my screen?
Yep.
Okay. All right.
Mike, I hate to do this to you, but just on a thumbnail, can you break down your process again, kind of from the beginning, just in like a 2-minute drill?
Yeah, let me just I'm changing around some monitor stuff right here. Give me 1 second. All right. Well, my process, again, we have the concept of the rotation zone, and we use major tools like harmonics, which are 12.5% increments in the markets, whether they're extensions or retracements. And we use a major concept called the rotation zone. Up on the screen right now, we have the rotation zone, which is between the blue line and the orange line being an 8 EMA, exponential moving average, blue line being a 21. We watch for rotations. We actually ran up earlier this week into the rotation zone and now have spent 3 days rotating back down, also completing. We use price action patterns. We completed a major significant double top today and then continue to run a little lower next to our not exactly. The next harmonic target was 36.3325. We hit 36.3250. So, and funny enough, I don't normally pray to the market gods. I actually said a prayer as this podcast is starting, because as long as we had at least a trade below 36.3375, we could have a potential bottoming pattern going into next week, so I could talk about it.
Okay, good. I liked your bottoming pattern. I've had enough.
Oh, you're not going to be happy on the other side of that also, though.
Okay.
So, would you like me to cover the two scenarios, because they're pretty extreme?
Absolutely.
We are set up after this move today and the market internals, we are set up for a potential capitulation day/week next week again. And actually capitulation bottoms would be a medium term potential bottom in the market, which I do like, but it would require a significant flush down move. Essentially, and it depends not just on price, the pure price, but also how market internals react and volatility reacts. But roughly now we're looking at least a flush down move about below 34.75 in the futures. That is one possible scenario. We should see some continued downward movement in the beginning of next week. Also, if we do not get we could have orderly declines, but with this price action going into Friday's close, we have a potential bottoming pattern if we don't get a capitulation pattern, which even if we go retest our lows from the end of September, beginning of October, it would only trigger on a closing basis above 37.94, and that would be a daily close, and that could be a potential return all the way to roughly 4,750 to be exact.
Right. Got it. So what about, so how do we see the bottoming, like what was going to give us a clue that this all hellish down move is over?
First off, probability wise, with slightly over 70% based off where I think we're not closed yet on the futures, but where I think we'll close, we should see some short-term follow through between the lows, and this is a target zone of between 35.7175 and 36.0275. That's a target zone. As long as that zone holds, we will be watching for a shorter term bottoming pattern based off intraday data. If we start breaking below the lows from the beginning of October with momentum, then we're looking back to that 34.92 to 34.77 with a potential capitulation move.
So you'll know it's a capitulation move by a spike in volatility as well?
It will be a spike in volatility. It will be, there's a number of metrics. It tracks things like your cumulative tick index, how that reacts all day. It tracks the breadth statistics. It tracks how deep the market is in the futures, and how well it's absorbing, in this case, buying pressure. But if we did get price action down there, especially in a 1 day, it doesn't have to close down there. But if it were to spike down there in 1 day and you saw the VIX at least above 35, you'd have to tune into the YouTube channel for the exact, if it did hit capitulation statistics, but there's an exceedingly high probability it would have just been a capitulation day.
Got it. Okay. Bobby, you have any questions about this?
No. I'm good with it. I mean, I've been telling people on our YouTube channel that I believe equities will be higher in the fourth quarter. As crappy as I sound about all this stuff, as crappy and shitty as I think everything is overall, I think equities will actually have a positive fourth quarter, but not be positive on the year, obviously.
And can I just reiterate one thing?
Sure. Yeah.
Just because we have the potential for capitulation does not mean it has to happen. It's a rare thing. It's not something you line up every week. You go, oh, we're set up for capitulation this week. No, there's a pretty substantial hefty bar. We've been set up a couple times in the last few weeks for capitulation. We're set up there again, but that does not mean it has to happen. We could stabilize here or slightly lower, as I said before, turn around. And again, if you get that daily close back above 38.20, hey, you have now high probabilities that you have put in a substantial bottoming pattern without capitulation that could easily take you back to 4,000. The intermediate targets, I'll just list them off for people so they have them: 39.13 and 39.60.
Okay, so to put a fine point on something, if we trade or settle back above 38.20, you then believe we could have an extended move that gets us to a four handle?
Yes.
Okay. So that's what, if you want to be a bull and like to be a bull from, trade from that side, that's what you're looking for at this point in time, is 38.20. I got that.
Correct.
Okay.
And then let me reiterate one other thing, just because I'm only on once a month, and if that,
yeah,
because anything can happen with holidays coming up, or my extended questioning of Jim. If we get another daily close above 4,044, the probabilities would then shift to continued higher prices going into the end of the year.
Okay.
So
Okay.
those
So
are your bull cases.
Yeah, just to underscore what we're looking for on Monday. Monday, what are we looking for?
What are we looking for Monday? I am watching still based off of this data. I'm watching for us to put in a shorter term bottom below, around that, just slightly below 3,600.
Okay, got it.
For Monday specifically.
Okay, what do you want to look at next, Bobby? Got any ideas?
Yeah, no, let's go to crude oil if you don't mind. I mean,
Love
we'll
it.
look at the other equities if we have time, especially NASDAQ. I want to look at crude oil.
Yeah, so do I. I was hoping you'd say that.
Yeah.
All right.
Crude oil, you guys were talking on Friday afternoon. You guys know the story. This week, crude oil was just bid because Saudis, as Bobby told us on the show for the last 2 weeks, we're going to have a production cut of 2 million barrels a day. We're in a tight spot. We got our SPRs drained to very, very low, and now prices are moving higher quickly. Take it from here, Mike.
All right. I actually have to check on something real quick. Ooh, we might be, it's going to be really close. No, we don't have, I was just seeing if based off the longer term commodity system, we had a potential significant buy signal. We did not get it. Remember before, I know I mentioned this on one of my previous appearances, we had that weekly double top pattern trigger with the first target of 77.56, which was hit. And then we've bounced off it strongly. Now, for the short term, we should still see, even with a pullback, the first key pullback level is 88. The major pullback level is 82.70. So as long as we don't see a daily close in the short term back below 82.70, we still favor continuation higher prices. The next, you had me talk about the rotation zone. Since we went above the daily rotation zone, the target was the weekly rotation zone, which came in roughly 92.50 to 93. We've hit 92.50 today. So that target's been hit, I should say.
Can I ask you a quick question?
Yes.
When we hit the upper end of the rotation zone on the weekly, I know that was your target, but it is also resistance. Do we look for it to potentially turn around there?
We are looking, not only, we don't just say something as a rotation zone as just one thing, but we do have a cluster here. We have a prior major breakdown level back around this 93 level. You also have the prior target of that double top that was triggered and hit first target coming in at 92, 93. So when we have multiple things lining up in an area, we call it a cluster. We're against a cluster right now.
Can I throw something in here, Mike?
Yes.
So Mike and I have been partners for double-digit years, and something we've always come across, I mean, literally always, is, well, reach your target, why don't you just flip, right? So for example, the first target on this double was hit. Second target was not. Doesn't mean it won't be, but it was not yet. We get that. We've gotten that over the years, especially by retail traders all the time. And I want to point out again that a target isn't necessarily support or resistance, but often is. So it's a fair question to say, is that particular target support or resistance? But, you know, people have literally used Mike's stuff and been like, okay, I was short, target hit, now I'm long, resistance hit, now I'm short, and gotten killed. Because it just doesn't work that way.
Right.
Targets are a place that you want the market to get to, because obviously you want to take profits, or you want to reduce your risk by adjusting your stop. So I just want to point that out. In this particular case, Mike answered the question. The answer was yes, because there's a confluence of other things, but it is not always the case. I don't want people to watch these podcasts and go, you know, Mike said there's a target here, so that means flip.
So I think that point deserves to be underscored again, because I do that sometimes when I'll like have a trade on and it gets to the target and I get out, and then I say to myself, wait, then am I supposed to be flipping and getting short here because that was my target? And it happens all the time. But no, all that means is you are back to the drawing board. We have to remember that trading is boring most of the time.
Right.
Trading is watching screens and waiting to pounce. And sometimes that can take a long time. But thank you for that. What else you got for this, Michael?
Next target higher is 96.50, which is very significant. So anywhere between this 93 and 96.50, I will be watching for a shorter term topping pattern. We do not have one as of the close on Friday. I am watching for it. On a trailing stop basis, a close below Friday's low, a daily close below Friday's low, is from the way we do things, a close out the final shorter term longs, which would be a close below, whoa, is that today's low? 88.
Yeah.
Wow, 88 exactly. So only on a close below today, Friday's low, is it otherwise we don't have we have a short-term resistance area, but not a topping pattern. To go into your point, means there is no short trade at this moment in the short term.
Okay, that makes sense to me. What do you want to move on to? You know where what I want to move on to eventually. I want to move on to copper. I want to move on to the euro. I would love to move on to silver. Bobby, you pick.
Let's do silver.
Okay, good, because that's my
anything but
too.
Silver. All right, you gotta pick one of the difficult ones.
Yeah.
What's interesting is there's still substantial odds that we should see lower prices, and I'm talking above 65%. That we could potentially, the next targets lower are 1642 area, then 1407. That's the bear case. And from a also longer term perspective, we've broken key support. We're into one form or another of more significant clear path moves to the downside. Right now, we are trying to put in a short-term bottom. We had the possibility of this week with a close above about 2120, which is, as of today, now off the table. So right now, it's in short-term consolidation, shall I put it, still favoring longer-term lower prices, unless we now for next week would need a close on a weekly basis above 2131.
Okay. So what do we look for to signal that the continuation lower is upon us?
Let me give you that data. Always with the questions.
Yeah, that's kind of the
No,
that's
those
kind of
good
our relationship
questions.
here.
See, this is what's nice about this stuff. You need a daily close below 1886.
And that means game on.
That means game on to retest the low areas from the beginning of September. Exact price wise would be 1780, between 1789 to 1740 for at least in the short term. But if you start breaking down below there, the bear trend is really intact then. And my next target would be 1632.
Okay, so tell me this. There's a line there, the blue line that's just below the candle's bottom today, that also corresponds with some highs from what appears to be a couple weeks ago, right? So is that, what is that level, and do you find it significant?
Okay, this would be a key harmonic. So it would be the 37.5% harmonic, which for the short-term basis, I was trying to keep things a little longer term, but since you ask incredibly smart questions, we have prior resistance back from the about September 13th and September 22nd becoming potential support, a rising daily rotation zone, and it so happens that that 37.5% harmonic is right at 1984, right around that key area. So in the shorter term, I shall be watching, since I gave the key pullback levels and we're nowhere near that close below that 1886, for a potential support trade on the shorter term basis here. And as of today, I need a reversal move back above about 2064, but we may set up for a more aggressive reversal move depending on how the price action unfolds Monday, beginning of next week, in that area around that 1984.
Bobby, is it okay? Because the reason I want to look at short-term silver too is because the trade I'm going to give out today is a silver trade, and it's somewhat shorter term. Is this a good time for it now, Bobby, or should we do what we usually do and wait till the end?
Yeah, Mike does multi-time frame analysis all day, so I don't think he's worried about it.
No, I'm fine with whatever.
Here's the trade. Again, the euro trade I'm going to give, I actually have on. The silver trade I do not. Most of you guys who follow me on Twitter know why. I am in my long-term positioning and uncomfortably long silver. So if we were trading to the downside, I'd be much more willing to put those short-term trades on. This is a trade I considered and then did not do because of my positioning already. But silver December, looking as the micro silver, a buy at 2025. I think it's a little lower than that now. So a buy here, let's just say, with a target of 21.90 on the upside and a stop placed below 1910. I chose that 1910 because it seemed to be below a lot of that congestion area. Do you think in a short-term trade that could be successful, Mike?
Yes. If you want my stop personally would have to go below 1886 because you're right in a potential between, just for everybody's knowledge and for researching, between the 50% and the 62.5% is a very key reversal zone. Once that 62% is broken, especially on a closing basis, that reversal zone is null and void, and you roughly then target the 87.5% harmonic. So to translate that into prices, my stop would have to be on a daily closing basis below 1886. Other than that, you mentioned 2190.
Yes.
Which would essentially be an exact target area. Where's that derived from on these charts? So happens to be the 200 simple moving average and a prior resistance shelf from back in mid-June. So that is an excellent target because you're also going into a clear path move back above 2120.
So for those watching too who haven't traded micro silver, I don't know who the hell named it micro because it's 1,000 ounces. So that trade, if you bought it at 2025 and took it up to 2190, you make $1,650. If you get stopped out at 1910, you lose 1,150. And by the way, people from the CME, I know you watch our show. we should really have a nano silver contract because Bobby, do you agree? A thousand
Yeah.
ounces is a lot of silver for a lot of people out there.
Yeah, it's still a lot of silver, but I suspect the CME has been pretty proactive at responding to individual traders lately. So we'll see. But I agree.
Yeah. Yeah, no.
Can't we just go with a Pico contract?
What? Good, nice one. I was trying to think of what the word was. Nano is something, right? That's a word.
Actually,
Yes.
if you don't mind, can we do this then? So we already did the ES, the mini S&P, and I have an S&P.
Oh yeah, you didn't give your trade, right?
So it might be a good idea to jump back to that if Mike's okay with it. And the
There you go.
daily's kind of where we're looking at. So I'm in this already, and unfortunately, we'd have to get a fairly large rally back. I did not expect this, although my target may seem like it did. And I already mentioned that I'm bullish for the fourth quarter, but I'm short the December micro ES at 37.10. Okay, now something that we've done over the years is drawn these best fit trend lines, and I really like those. Michael probably know exactly where I'm talking about. When you get a move back up into the rotation zone, we draw these best fit trend lines, and when we get a close below one, it can be a fairly reliable short signal if all the other parameters line up. So I drew a best fit trend line from basically those lows at the beginning of October straight up into the rotation zone. And then I went ahead and sold a break of that trend line, but then I extended my target to about 34.56. And I think my stop might be a little high based on what Mike just said. My stop's 38.95 and Mike's been talking about 38.20. So anyway, short at 37.10. My stop price is 38.95 and my target is 34.56. If you make money on this one, it's a $1,270 per micro contract. And if you lose, you lost $925 per micro contract. It's about a 1.38 reward to risk ratio.
So but I'm going to ask you this question before I ask Mike. If you get to your target, which is, what is it again, 34 and change?
34.56, yeah.
So do you, in your mind, because I know you said that you're a bull for the fourth quarter, and that could be for a host of reasons.
Yeah.
In your mind, is that it?
Yeah, that would be the near low unless we close below that level. So it's interesting. Mike does the harmonics. I still do a lot of GAN retracement extensions, and it's a 62.5 retracement extension from a recent move. And I like the 62.5 a lot. And if it closes below there, it likely extends, but I'll be out of the trade anyway, because I'm semi uncomfortable from a fundamental perspective with this trade. Also, we get the capitulation move. I hope it capitulates to my target. That might be a little bit of wishful thinking. So
a little sidebar. So during this whole period for the last 2 years, we've never really seen the VIX spike, to 50, 55, 60, but all along the way, we've seen a consistently higher VIX for 2.5 straight years. And there's tons more participation in options market than there ever has been before. My question to you, Bobby, is do you think that it's still for people like us in the past? I heard Jeff Kilberg, of all people, say it, and I thought it was brilliant, which is the only brilliant thing ever. I'm just kidding. We give Jeff a hard time, but he said, when I see a VIX at 60, I buy the market. And I think that that's pretty brilliant. Are we going to be robbed of that signal for other reasons just because of it consistently being higher?
Well, so I think people lose the realization that options prices are what determine the VIX. So rather than the other way around, a lot of people are like, well, the VIX is high. That means option prices will be priced higher. It's the other way around. Option prices have gone higher, therefore the VIX is rising or rose. I think as people get more and more sophisticated with their options exposure from a hedging perspective and a risk management perspective, we may not get those spikes anymore because people may be positioned with insurance, especially the new retail crowd, the crowd that's never invested without Fed manipulation. I shouldn't say manipulation, without Fed involvement. Right.
None of the Fed guys are going to come on this show anyway. They probably ate
True
up.
story.
So, yeah.
But I mean, literally, when was the first Fed intervention? 2008.
Yeah, without
I
question.
mean, we've
I'll
been
argue
trading.
that it started back in the 80s when they kept rates inorganically low.
Yeah, okay.
I think it's been
That's
for
fair.
decades. Yeah.
That's
Yeah.
fair. But I mean, certainly the activist Fed, you can go back at least 24, 25 years. And
Right.
there's people that haven't traded without an activist Fed. And so people I think are getting, and Mike's actually an options expert, so he might want to chime in on this as well. He got his start at the SIBO. But from a perspective of it, we could start seeing lower and lower VIX. Jimmy, you and I spent a lot of time together in the interest rate quadrant. Remember how big the swaps market was and how much it shrank?
Mhm.
Because people
Yeah.
started realizing what was happening and they started taking advantage of that. It might be the
Yeah.
same sort of thing,
Okay.
just with different products.
But Mike, then the question to you then is, if we're saying that so many more people are involved in options and so many more people may have proper hedges on and not just ignore risk like they had in the past, and that we can prove that maybe by a longer term higher VIX over the last 3 years, isn't this a good thing? And maybe do we pat ourselves on the back for talking about these products for years and hoping to get people involved in it? Mike, what do you think?
The problem I'm seeing with the options market in general is, it's being the utilization has gone way up, but the utilization has always been there from the big boys. The utilization now has gone up by very naive, uneducated players, from my perspective.
So the utilization has risen, but the sophistication is not.
Correct. And I'm going to give you one other thing for anybody who does listen to this that likes to model systems or do research into just moves, even with the VIX. I've done extensive testing with this, and it's not the absolute value that matters. It's the percentage change from a baseline that matters, especially feeding into systematic principles. So if you're looking for something, it's not like we could have a percentage move that would, it's not like, hey, I gave out 35 on the VIX level for now because it's based off a percentage level of where we are, and that would be roughly. But don't just say, hey, anytime we go above 35, it could be a capitulation move. No, it's based off percentage increases, not absolute values.
Okay, because that's a true measure of panic when everyone's throwing in the towel.
Yes, for example, we were at VIX at 15 versus a VIX of 45. You're going to have a percentage increase, but your absolutes are going to be different.
Okay, I get what you're saying, and I like that a lot. Okay, can we move on to the euro, Bobby? And then I want to finish.
I don't know if Mike is going to tell me to change my ES trade or not, but I don't care.
Oh, Mike, yeah, you have to. I mean,
the only thing, I'm not trying to change anybody's trade. My only key thing is we have a very key support zone just in front of that target. So I would be aggressively lowering my stop below 3,500. I would trail even more aggressively.
I usually do that in my futures trades anyway, so that's good. All right, go. What do we want to do, Jimmy?
I want to do euro. Yeah, because I have, again, I did make this trade. And what duration chart do we have on there?
This is a day, weekly, sorry.
Oh, okay, good. Yeah, though that's what I was looking at. Right.
This is the daily.
Right. So here's my DECE micro euro trade. Selling it at spot 9808, actually, because I dawdled on it, I got a little bit better price when I went in, but when I was diagramming it, targeting spot 9620, which is above those old lows, and stopping out at spot 9950. Now, normally, you guys on this show hear me talk about the psychological level of parity, and normally I'd be putting my stop above it. Although I do think, and I can't remember exactly what I based it on technically, but I do think if we come within spitting distance of parity again, we're going to shoot back through it. Tell me what your thoughts are.
Well, all right, I'm going to put up my lines. Could you go through the entry, exit, and target again?
So the entry is spot 9808. The target.
Okay.
The target is spot 9620.
All right.
And the stop out is spot 9950. And again, real quickly, if this trade hits, it's per micro. You make $235 per one lot in the micro. And if you get stopped out at spot 9950, you lose $177.50 per micro.
All right. I gotta look at my crystal ball here,
Sure.
which the boring crystal ball are, well, I mean, your entries, you've broken key support.
Right. That's why I entered.
You're from the statistical and probability wise, you still, if we get that daily close early next week below 97.65, I think you're absolutely golden, because then you favor a return to 96.50 to 95.92. So
Right.
you're golden from a probability standpoint on the close below 97.65. You did break recent support, so that's neat key resistance. And you said
so that's where we
not
closed. That's where we closed out. I see spot 9789.
9789 is where we closed. Yes.
Wow. When I left the trading floor and had put this on, I got it on at I think I sold it at spot 9811. But yeah, okay, good. So we've broken quite a bit. Yeah.
Yeah. So, and your stops up at 99.50, which gives it plenty of room. Let me just reverse my harmonics real quick, because I want to see. It's pretty much right at the 62.5. So yeah, if that stops within, right at that key area. Your early warning sign, I just want to double check something, because going into beginning of next week, if we get a 4-hour close, and I normally don't go to the 4-hour time frame, but if it closed on the 4-hour and then translated into the daily, it would be fine above 98.07.
Okay.
You could see some upward pressure at least to 99.07, which is, even with that potential little short-term reversal trade, is well below your stop.
Well, also, because what I may do actually, based on what you just said, since I got a lot of room in it already, it's gone my way, because that would be essentially a break-even stop. I normally hate moving it to break-even stops, because it always seems like you will, in fact, break even when you have it there. But I may do that because it moves so quickly in my favor right away.
Which is a way to use future price action to fine-tune a trade, because it's not just, it went my direction, let me move my stop. No, it went your direction, and now there is a key pattern that would be triggered. So that is not just moving your stop for a willy-nilly, let me lock in something. It's, hey, I have new information.
Let me throw something in on that. So a lot of people will move to break even, and the thought of moving to break even, while is a very comforting thought for a lot of people. This way I can't lose. As Jim mentioned, oftentimes it does go to break even, and that's because your break even point isn't necessarily a spot where new price action has respected. And so people will put it there. That's kind of a fear-based decision as opposed to a price action-based decision.
Right.
So you're often better off saying, okay, there's a price action reason to move the stop here, even if it's still a small loss. Those stops will be hit less often. So instead of saying I'm going to move my stop to break even, you might want to say, okay, I'm going to move my stop. I'll lose $1 now or $2 instead of the original 200 I was going to lose. People will say, I'm just going to move it to break even. This way I don't lose any money at all. But that's a fear-based decision as opposed to a price action-based decision.
Yeah,
so
I love the way you describe it too, because if that's the way
you trail your stops based on what price action has done, as opposed to based on, I don't want to lose any money, it'll happen to you less. I can't tell you what level of less, and I want to throw out that I like this trade, Jimmy, a lot, because if you remember last week, I had a stop in at 98.09 to the downside. Now, the spike that we got, which you can clearly see on the daily chart in the euro, is like a 5-year high, like a 5-year percentage move. It's the biggest percentage move the euro had in one day in 5 years. That
Right.
actually blew through my planned stop. Now I wasn't in the trade because my stop in didn't get triggered, but because this blew through my planned stop, it destroyed the reason for getting in the trade. Now I still like this trade that you have, but within my process, within the context of my process, I don't have the okay to get back in, but I still think my target's going to be hit. I still think everything's going to go well with this trade. So I like it, but I'm not
Good.
in.
Are we good? We have time for one more. The reason I changed
Sure.
shirts is I got to do Cudlow at 3:30. But
Let's do copper.
let's do copper and let's go a longer look. And the reason next week on Friday, I'm giving a speech at the New Orleans Investment Conference. And a big part of what I'm going to be talking about is metals of the Green New Deal, metals and Fed policy. And I'm going to be looking at copper. Now, I know copper chart currently looks like death, but Mike is going to explain what has to happen for that death look to be gone and when it starts to become the place to be.
There it is.
The only bullish thing I have right now is based off a close above 378. So we need a weekly close above 378, and that would be for a longer term trade with 405, 418, and 432 as the targets. What's interesting is we spiked down to a critical level, which has been on the charts for a long time at this 312 area. If we get a close below 312, watch out below.
Right.
You will probability say easily to 274, 275 area if you get that close below that 312.
Okay, that makes sense. But if I am going to make a fundamental case, which I am for copper over the next 5 years, I think it's absurd that the fundamental opportunity that's happened with the dollar rising and 2-year yield just going through the roof at the same time, China, who's long associated with copper, has been having these sporadic and unexplainable lockdowns for COVID. These are all temporary things that could be keeping a lid on it, but I won't buy it until there's some sort of technical reason to buy it. And give that level for me one more time. A weekly settle above what?
The weekly settlement above 378.30. So 378.
Got it. Okay, that's very, very cool. All right.
That could be traded on a shorter term basis on a daily close, but if the weekly did not close above that level, it would not be something to carry forward. Let me give you an early warning sign. An early warning sign as it stands now, this level, if we do break down below the lows from September 28th, this level will change. Right now, those lows are 324.30. So if we break those lows, don't throw this level out the window. But if you get a short-term daily close above 358, we should see a probable move to 371, which could be a front-run entry.
Okay, interesting. Thank you very much. Bobby, you got anything else? I kind of got to get going. I got to do another.
No, go ahead. I love the 5-year plan for copper because despite I think the House is probably going to switch and the Green New Deal might go away longer term.
Yeah.
I mean,
it does. Yeah, it doesn't seem to matter. I mean, we're going electrifying a lot of things, regardless of Green New Deal's in place or not.
Cars, so
right. And also extraction, like, I don't know, we'll talk about it often too, but like to get a permit even in Chile to mine copper takes 3 times longer than it used to. There's a lot of reasons that supplies are going to be very, very tight. Although my thesis is mostly going to be at some point in time, the Fed's going to pivot, whether that's in a month, 6 months, 8 months, that remains to be seen. There's going to be a point in time where China stops being ridiculous about things. I mean, you agree with both those two premises, right?
Absolutely.
So my speech is going to be about 4 minutes long. Thank you, Michael. Thank you. This is always fun. I really do. This is one of my favorite shows to do every month because everybody, we talk about the fundamentals. We have some unbelievable fundamental minds, but the way prices move, to guys like Bobby and I, and obviously Michael too, is much more tells the story of what the fundamental story actually is.
Well, from my perspective, the fundamentals, I love fundamentals from a longer term perspective. However, I can't trade a fundamental viewpoint. I need to trade something on a chart, and that's what this does.
Amen.
Show them
All
your
right.
heart, show them your sugar monitor. It'll explain you a little better.
What is it?
Oh, I can't. I have a long slip, but I'm worried. I'm now doing, because that's one of the reasons I have not been drinking now for 10 weeks, which will end at the holiday season. However, now I'm doing my technical analysis. I'm wearing a full-time glucose monitor to track what every piece of food I eat, what the effect on my short and medium term glucose levels have. So I'm doing my technical analysis on my own body.
And your body. And you're not a diabetic, right?
No, he doesn't need to do this. This is just how weird he is sometimes.
No, I love deep dives into analytics, regardless of what it is. To me, that's freaking brilliant. I love it. Again, people might think guys like you are crazy. And where was I going with that?
That they
Exactly.
All right.
They are.
All right. I'll see you guys. Have a great weekend.
See ya.
Cheers, guys.